what nobody is talking about. Justin at Ivy League Trading here. I'm going to go over a few things. I'm going to recap the week. We went through this data. We're going to go over Fed funds rate. We got a whole lot of stuff for you. M2, commodity index, a whole lot, guys. So let's start with this data. All right, unemployment rate ticked up to 3.7. Non farm payrolls, 339,000 jobs added. Wow, not added between month over month, but crazy number. Kind of doesn't make sense, does it? Unemployment rate ticks up and non-farm payrolls also pick up. I'm not sure how that works. Anyway, participation rate came in line. It actually ticked up just a basis point, 62.6 versus a forecast of 62.5. Average hourly earnings month over month, 0.3. Pretty much in line, same as last consensus. It actually ticked down from the previous month, year over year. About the same thing. Ticked down a basis point. Government payrolls obviously increased because of the individual who was in office. So we can obviously see that, but I'm kidding, so don't get in a bunch. But anyway, manufacturing payrolls minus 2,000. Previously was 10K, consensus 6, forecasted 3, and we are negative. Non-farm payrolls private, 283,000 versus an estimate of 165,000 was the consensus, and then forecasted 170. So total vehicle sales, 15.5 million versus a previous of 16.9 million. Again, Baker Hughes oil rig count 550. There was no consensus. It was just previously 570 rigs. All right. And the Baker Hughes total rig count was 696 versus a previous 711. What does this data show here, guys? This shows a very slow. This shows slow growth. All right. Just the data today. All right. Unemployment's ticking up. Total vehicle sales ticking down. All right, we have this debt ceiling that got passed the House, it passed the Senate. Now Joe's getting ready to go sign it. So that's came through. Now there's this thing with college tuitions, the loan forgiveness program. So it's going to be interesting to see how this data what this data comes out as, and what these people have done with their money. You know, have they taken on new car payments? Have they taken on a bigger home, a bigger apartment? And now that extra cash isn't freed up. Did they save it? I would sure hope so. I don't know about saving it, but I would have hoped they'd invest in it of some kind, because saving ain't going to get you nowhere. Saving gets you behind. They don't teach those things in school. All right, let's go on to what really matters, guys. Fed balance sheet. This is what I don't think anyone is talking about. All right, June 14th, Fed data. Hopefully, we get more clarity on what they want to do with this, and we can so the market and we as market participants can get an understanding of, get an idea of where they want to be. Do they want to be around 7? Do they want to be at 6? This has nearly doubled. Okay, nearly doubled just from 2020 to 2023. In the past 2 years, this has doubled from about 4 trillion to, well, it was damn near at 9 trillion. All right, these are things that are going to drain liquidity. Okay, Fed Watch tool. We're going to keep an eye on this leading up to the Fed meeting on the 14th. The 13th, we have CPI. So keep that jotted down. All right, remember that, because that's going to be very important. All right, unemployment rate. I got something interesting that I want to show you guys right here. This is what nobody's talking about. This is what nobody's talking about that's going to lead us into the markets, okay? You could get the markets, we could go higher for a lot longer and kind of put in a U shape, an upside down U. All right, we could tick up to 350, 360, and then roll back over in 2024. There's all kinds of options the way that this thing could turn out. And I want to show you guys something here, okay? This is the Fed funds rate with unemployment. So if we look, let's look here in the unemployment slowly ticks up here. Okay, what is this? November 1966. It peaked. It started to tick up right here. November 6th or July 1967. All right, so we have that. Let's go to March 1989. Fed funds rate peaks. It holds. June 1990, uptick in unemployment. All right, you're going to see something here, guys. What do we have? June 2000, peak in rates. We hold. February 2001, so just under a year. Well, really the tick up starts in April. So what do we have? We have a rise in rates. We have a peak. We have a hold. And then we hold for a year, and then we have a tick in unemployment. Again, a peak in rates, hold, a year goes by, August 2006. November 2007, peak in unemployment. Now the blue graph is the unemployment, the red is the Fed funds rate. All right, peak in Fed funds rate, hold. Year goes by, uptick in unemployment. What do we have here? 2019. January 2019. Peak in rates, hold. A year goes by, and a peak in unemployment. A tick up in unemployment, guys. So what I'm getting at is, are we at the peak? This brings me back to the Fed funds rate. All right, and the balance sheet. Are we at peak? What is peak? Is peak 5.25, 5.5? Okay, I would think 5.25 is it. Okay, 5.25 may be it. They know this. They see this. This is the only type of data that they have. We have. They obviously have, different types of data. But the point is there is a systemic lag of nearly a year on average. Go through this. Go to the St. Louis Fed site, okay? And you can make this, and you can just sit here and go through it. This is just one of them. Again, I have the unemployment rate along with the Fed funds rate. And what you notice here about 4 or 5 times is you have a peak in rates. And when you get to the peak, you hold, a year goes by, unemployment ticks up. All right? So I can go back and do a little bit of work with the Fed funds rate. But if we were to just say that they started January, February, March, what they start about March of last year, and we're a little over a year, but we still haven't peaked yet. We still haven't peaked. They've done all this in 1 year. So it's kind of backwards. Now, could I go back and see how long it took them to raise? Yeah, we can. So from here, they started in 2004, and it was in 2006 at the peak. So they went and did that in 2 years. Now, and this was from roughly, give or take, effective Fed funds rate was 1.03, and they went to 5.25. So not that bad. So this is pretty close, guys. About a year and a half. How long did it take us here? We've done it February, like I said, 0.08 to 5.6, where we're at now. So this should line up. We should see a lineup. We come up, we peak, and we hold. Now things start cracking, what does that do? All right, do they start bringing rates back down? Do they bring the Fed funds or the Fed's balance sheet back up to provide liquidity to fix whatever problem is there? So I'm really curious on this meeting on the 14th that's coming up. What are they going to do with this balance sheet? They all say that they want to have the balance sheet runoff. They haven't hardly done much. It's taken a while. I have written down some numbers here. Again, like I told you, their balance sheet has doubled in the past 2 years on average. So we have here Now this data was a little bit behind. So there's been about a roughly a decrease of 90 billion from 8.8 trillion to 8.7 trillion. And again, I think I have it up here. That's the M2, which is also on a yearly decline. Where is 2023? Probably right there. Yep, January 21.28, and we are at 20.8. So this is all showing you Fed funds rate, the data. It's all showing you a slow in growth. Okay, a slow in growth. All right, M2. Look at the commodity, guys. Look at the commodity index. This is the Bloomberg Commodity Index. We'll go year to date. Decline. It's actually been on a decline for about a year now. Close to a year. Yes, a year. See, decline. But it's also still stuck pretty damn high at all, So it's coming off that peak in 2022 of around July or June. So I wanted to go through that with you guys. This was pretty interesting here. With the unemployment, with the Fed funds rate and unemployment, how you had a peak, hold, and a year goes by, you get your uptick in unemployment. Okay, get your uptick in unemployment. Now we're still sitting at high threes. No matter, we could tick up, we could tick a little down. As you can see here, this is what we've been doing. You're just ticking up. It's in a down direction, but I think right here it's picking up. I think we're picking up. So, do we hold through the summer? Everything goes smooth? Are the banks taken care of? The banks were green today. Did the Fed solve that problem? We don't know. But I can surely tell you with a little bit of time, because everyone felt like today that like the market isn't supposed to be doing what it's doing. No, listen, you should not have an opinion on what the market should be doing. The market's perfectly fine. Okay, the market's fine doing what it's doing. It's not hurting a soul. Let it be green. Things are okay right now. There is nothing in the news that should be bringing the market down. All right, banks are up. Okay, you had some banks raising dividends, saying deposits were up. All right, you have the debt ceiling that's been passed. What is there to bring you down other than the war that has, been priced in that you don't even hear about anymore? At least I don't. I do, you do see it on Wall Street or, the Wall Street Journal. But as far as being in the news and being front and center, it's like non-existent. It's non-existent. I don't know if I'm the only one with that feels that way, but it's going to take something, serious, as far as the war, for the market to start pricing in something about that war or something with China and Taiwan and the United States. So what could be looming? What is there that's in the background, and when does it come? All right. So today we had yields run higher. Okay, your 2-year yield 4.5, and I think the 10 years around 3.9. I think, or 3 points. Let me take a guess before I look it up. It should be like 3.6 or something. 3.6, 3.7, really, 3.7. I was a little off. Okay, so we had an uptick in yields. All right, so this 3.6 to what was the 2-year 4.5. So that's about a percent spread. So it feels like the spread has been getting shorter, correct? It's getting thinner. So you'll have to go back. If you look at your 2s and your 10s, the spread is the difference between the two. So if you have the 2-year at 4% and the 10-year is at 3%, that's a 1% difference. That's a 1% spread. Just for those of you who don't know. All right, so that's not going to bode well for TLT. All right, so if we go to the ETFs, guys, we're going to go over what happened this week. So this week, we started red, slightly red, Tuesday. Wednesday, you've seen the shift from red into green. And then what did you have Thursday and Friday? Well, the S&Ps had about a I don't know. It was a big run though. I'd have to pull up my chart. It was about it wasn't 16 points, but yeah, it was. I think we were around 416. or so on Thursday. I don't have my charts up right now. Actually, we do. So we'll go to the SPY real quick. And you guys got to think about this stuff because, you know, just as quickly as things turn on a dime, all right? This is crazy. So where were we at 2 days ago? What was that? Thursday, June 1st. 417. Yeah, so 416. I was right. So we had a low of 416 to 430, so almost 15 points, 14 points. In 2 days. 2 days, you've had almost 15-point upside in the SPY, guys. And we still rallied on the back of rates rising. Okay? So, keep that in mind. Green across the board. I mean, just green across the board. So we ended the month and we started the month green. Okay, we ended the month, started the month green. The world is green. ETFs, you're just going to see TLTs and corporate bonds and all that such come down because as yields go up, the prices come down. As yields come down, the prices go up. If you don't know that already. But guys, look at this. Just green all over the board. Now this red here is your UVXY. This is your opposite. Like, this is the reverse play. Like if you want to have some insurance, and you go ahead and you purchase one of these. Now, you don't want to just purchase these and sit on them because some of them reevaluate the next morning. Like they recalibrate, you know, for the day. So I wouldn't suggest doing that. I would do your research. Again, I'm not a financial advisor, so again, go do your own research. But what a week, guys. UCAR, there was a lot going on. Gold got smacked. So I'm keeping my eyes on the metals, okay? I want to keep my eyes on the metals because I feel like there could be some opportunity there. The S&P 500, right? Do I got that? As a whole world S&P. Where is it? Fool. There it is. Where is she? Right here, guys. Gold. Basic materials. Everything around it was green. Okay. Everything around it was green. Let me see here. AEM, WPM, Newmont. What is this, guys? So this was basic materials. So again, there you go. There's your silver. And Silvercrest, other precious metals and mining companies. They've been on a pullback. Oil was green today. Oil was green. I mean, just look at this, guys. This is insane, right? 1 month relative. Consumer defensive. Utilities down. Technology. Consumer cyclical as a 1 week relative leader. Real estate. All right. Let's go to the 3 month. Half year. So these are some things that are pretty useful if you want to look at them. So we had some. We had UCAR today. I can't remember what I traded today. Don't think I traded much. It was small. If I did trade it, I know I put on a couple trades. I just have to go back through my book and look. I have to go back through my orders. UCAR didn't give us the run that we were looking for. Now, it felt like that was because it had a low float. It felt like it was one that we could possibly get to 20. That was our target that we mentioned was 20. We're gonna bring up the charts now. So again, guys, the Dow. So what happened today? Today was actually a pretty healthy move in the markets because you've had this big spread between the NASDAQ 100 and the IWM small cap, okay? So today you had, what leaders did you have? You had the Dow, you had the small caps, and you had technology pull back today. Technology was your laggard. Technology was your laggard. I don't know what is going on here. Oh my god. Yes, I want to close it. So I'll have to go through my charts, guys, but let's bring up UCAR. UCAR was one that I was looking that I was like, I'm gonna give it to this $10 mark. I said I'm gonna give it to this $10 mark and see if it can hang on and possibly make a run into the afternoon. Didn't happen. The whole run today, guys. Amazon. Amazon was one that we played today. There was news. Your AT&T, your Verizon was down because they said with the Prime members that they were going to offer them, I guess, cell phone service or something of that nature. So they were down about 6-7%, if not close to 8. So we took this Amazon trade right here. That was green. That was a green Amazon trade. I also hit it here. It was right around here. I took it. I think I didn't take a loss. I took a very small loss on it, yeah, because it ended up, right here. I was looking for the double bottom, and then it just, I guess you want to say it shook me out, but the markets were red. So there was a little mixed signal going on this morning. If I bring up the spiders. So this morning on the SPY, because what I do is I like to find relative strength or relative weakness, and I like to play the two. So this morning the SPY, we start off strong, and then we bull flag right here, and then just drop it. It recovers though. We recovered this drop, guys. Now, all day we're up here next to 428, 430. There's just people. Why is the market up? Why is the market up? Next time you say that out loud, like into like a group or wherever it is that you're at, ask yourself why the market should go down. Why? Just because the Fed has raised interest rates? Is that a reason that should bring the markets down? Okay. Earnings are still good. The earnings were still beat for the most part. Whether the estimates were brought down, it doesn't matter. The estimates were brought down. Majority of companies are still doing fairly well. All right, so what that means is that the labor market's still very tight as we got the data today and saw. As long as there's money going around, people working, and because what they don't have is the velocity of money anymore, the chart for that. As long as that's the case, things aren't going to be that bad. Now, when it comes to the banks and their lending standards, that's what's going to make a shift. And I think it just takes time, and I don't think people are giving it enough time. Because, again, as I showed you here, all right, as I showed you guys here, I'm just going to go back to 2008, 2006, okay? July 2006, we peak. We hold for a year, 2006 to 2007. Let's just get this right. July 2006, June 2007, and then what do you have? They dropped interest rates, but what do you have literally about 4 or 5 months after the full year of holding? You have the uptick in unemployment. Okay, so I think you're going to have to give it a little time. Now, every time is different. You're right. This time is different. You're right. Every time is different. Every time is different. You're correct. So I think that there just needs to be time. And you know what? There is also a chance that we could just sit here with these rates at 5.25. Is it possible that we could continue to just go on about this? So this brings me to, like, can we continue to just go on and live with 5% interest rates without without the unemployment ticking up like to a 7, 8, 9, 10 handle, which is extreme. I'm just talking here, so don't hang on every statement I say. But this brings me back to, okay, so what is the Fed's goal now? That's what I want to know. What's the Fed's goal? Like, you still have your balance sheet that you need to take care of that you haven't done anything with. You're trying to combat inflation. I get your job is maximum employment price stability. Okay, well, prices aren't going up anymore. It's been a full year. It could have been transitory in a sense, and maybe you didn't give it enough time. China was closed down. There was just this spur of just money that was just sitting in people's homes and people weren't doing anything, and then you just had and a massive amounts of just everybody just going out and doing things, and that's what caused it. But it was like a time period of like nothing that could relate to this. Like, this is not relating to the 70s. What if it was just a to 12 month period of just, a lot of demand, and now necessarily the demand isn't necessarily there, but it's pulled back a lot. And so now what does the Fed want to do? Do they want to actually bring prices down, like home prices, food prices and stuff? Do they want to start getting this balance sheet down? Because I also brought up, not the M2, but it's not up here anymore. I brought up the Treasury. Okay, I had the Treasuries. There was something I had. Where is it? I'm so upset that it's not up here. But I had the Treasury's balance sheet up here, and it was down a tremendous amount. So that's liquidity leaving the system. Okay, because when the Fed, like this, let's say the Fed lets these assets just fall off their balance sheet, as in they don't reinvest them, that's liquidity getting taken out of the market. So if you went and had a couple mortgage-backed securities or bonds or a security, and you got paid your interest, now what are you going to do when you get paid back? Are you going to reinvest it, or are you just going to hold on to it? So that's the question that we're asking the Fed, and we're going to get that on the 14th, guys. So again, we closed up green. I figured I'd give you guys a couple ideas. Watch gold, watch silver. They were down. Okay, nobody's talking about companies like DraftKings, Carnival Cruise. Okay, they were up. They were up yesterday, and I think they were also up again today. I'll go to the heat map real quick, and we will see if we can find them. It should be in hotel. What is it? Lodging. So you want to look like here you go, 3.5%, guys. Hilton Worldwide, Marriott. Okay, travel booking. Look at Expedia. Expedia's up 4.6%. So you want to take this and get some ideas. Now look at cat also, guys. Cat, deer, farms, farm and heavy construction machinery. We are coming into the summer, with the labor market this tight and things like just starting to show signs of slowing at a slow rate. Things are slowing at a slow rate. There's still a lot of money that was spent from the pandemic for projects, roads. You have the home builders have been going up, or all year the home builders have been on a tear. Now we just seen AbbVie was down yesterday, didn't we? So this is why you guys want to look at this stuff and look at it every night, because you'll notice things like I just noticed. Like AbbVie was down red, was one of the ones that were red, and now they're up almost 3%, 2.5%. Nike 4%. So I don't know if it's the jobs and the debt ceiling that's doing this. The VIX was what, 14? We got under that 15 handle, guys. Keep an eye on the VIX. All right, keep an eye on the VIX. Is this the last shakeout before something happens and then we rally? Because I was looking at the chart of I think 2008 and 2020. You have this period where it goes up and then you extend. See how it goes up and then just pulls back lower, and then the big one. Not to say that it's going to happen. It's just an idea, maybe with some time, So have a look at that. Keep an eye on the VIX. All right, premium. I mean, you got when you're at levels like this. Now this is just a sell-off. They're not even worried about buying insurance apparently, but in this environment, the banks are still at risk. There are still headline risks that are out there. You could get a number like an unemployment number out of the blue that you're not expecting. That's just way over expectations. Or you could get a CPI number that just, I don't know if you're going to, and I don't think you're going to, but just something could happen. It doesn't have to be along it's just something that none of us are talking about. But what I did want to bring up to you guys again today was this Fed balance sheet. You got to watch it. It's still up here high, guys. Watch the balance sheet. Watch the Fed funds rate. All right, this is what I don't think people are talking about, is the time. Okay, you peak, you hold for a year, and then the unemployment ticks up. Peak, hold, unemployment ticks up. Okay, thank you guys for joining me. Adjusting and Ivy League Trading. Have a great weekend. Stay healthy, stay green, and I will see you on the next one.